The squeeze play, the reason I like this play is that one of the things I've noticed in watching markets over, the years, is that, no market moves straight up or straight down forever, okay? Sometimes it feels like a market's moving straight up or straight down, especially like, platinum. But every market goes through this pattern where it has a lot of movement and then it stops and consolidates for a while, all right? And it's kind of like, it's almost like if you're watching a sprinter. I mean, the sprinter can run the 100-yard dash, but then they've got to stop and they've got to rest, they've got to recover before they can go ahead and do another one. It's the same thing with the market. That velocity cannot be kept forever. So what I like to look for is markets that have gone into a quiet period, okay? Now, the nice thing about this is it can be done on any time frame. It could be a quiet period on a monthly chart, okay, if you're looking for a new position trade. Or it could be a quiet period on a 5-minute chart. So it's not just one time frame that you're looking at. It's, it's not just one period. So everything's relative based on the chart that you're looking at. So let's say you're looking at a monthly chart like on gold, and we'll look at some charts on this. And it's been crazy for a couple of months, and then it consolidates for like 18 months. And this is actually what gold does. Gold makes its moves in about 2 months, and then consolidates for 18 months. When it went from 200 to 450, it did that in about 2 months. Then it consolidated for 18 months, generated a squeeze on the monthly charts. Then it went to 700 in about 2 months, consolidated for about 18 months, and now it's at 900, and it's probably starting to consolidate again. Well, what I'm looking for then is when these markets get into a quiet period, okay, first of all, I want to identify markets that are in that quiet period, and then secondly, I want to make a trade on it, right? So that's what this indicator is for. The first thing I'm looking at are the Bollinger Bands, and the Bollinger Bands are really good at measuring the volatility of a market. So if the market action gets really crazy, the Bollinger Bands expand, and if the market starts to flatten out, the Bollinger Bands contract, okay? So the Bollinger Bands specifically measure volatility. So the other thing I want to add to that are Keltner channels. Keltner channels are static, all right? They're going to stay the same length no matter what's going on. So what defines a market that's in a quiet period for me is when the market's quiet down to the point where the Bollinger Bands contract to the point where they're trading inside of the Keltner channels, okay? Does that make sense? So here you can see the blue lines. Those are the Bollinger Bands that are way outside of the Keltner channels, and then the market slows down and they just start to contract, and now they're trading inside of the Keltner channels. All right, so when I see that, that is a heads up on the squeeze play. It's like, hey, heads up, you've got a quiet market here. Okay, so that's the first half of it. The second half of it is, all right, so when do you get into the trade? What's the alert? So what I'm looking for is while these Bollinger Bands are inside of the Keltner channels, all I know is that this market has gone into a quiet period. I don't know if it's going to break to the upside or if it's going to break to the downside. When I want to take a trade is when the Bollinger Bands pop back out, all right? So when a market goes into a quiet period, you don't know if it's going to be in a quiet period for 5 minutes or it could be 2 years. I mean, you don't know. You don't want to like get into a trade and then wait while this market's in a quiet period for like a month because there's other opportunities that you could be pursuing. So what I'm interested in this trade is when it comes out of the quiet period. So when the Bollinger Bands pop back out of the Keltner channels, that's like, hey, heads up, it's time to take the trade. So how do you figure out whether to go long or short? So the second piece of this, or the third piece, I guess, would be to add a 12-period momentum oscillator. And when the Bollinger Bands break out of the Keltner channels, you look at the momentum. If the momentum is above 0, it's a long signal. And if the momentum is below 0, it's a short signal. All right? Does that make sense? It's a 12-period momentum. Now, one thing we did is just, and it's available, is to get coded this to more of an indicator. So you can see here when the Bollinger Bands go inside the Keltner channels, there's a red dot. The red dot's the heads up, hey, heads up. And then when it comes back out, you'll have the green dot. It goes back to green, and then if it's a long signal, if the momentum's above 0, it's a blue histogram. And if the momentum was below 0, it'd be a red. And then the idea is that this trade is valid as long as the momentum is climbing, and then once you get 2 lower bars in a row, it's over. I don't know if you can tell on there, but it's coded so that those turn darker. So these are the parameters, and on TradeStation, these are just the default parameters. So on the Bollinger Bands, the setting is 20 and 2, okay? And then on the Keltner channels, the setting is 20 and 1.5, and then the momentum oscillator is set at 12 periods. And again, it doesn't matter if it's a long or a short, it's the same way. All right, so that's how it works. All right, so here's the 233 tick, and we go back here and just kind of look at the day. So, okay, right here you can see, okay, the market's coming down, it's coming down, it's coming down. I mean, you get a short squeeze here, and then we start to go quiet. Okay, now this is on a 233 tick chart, so a quiet period on a 233 tick chart could last about 2 minutes, right? This is quick action that's happening. So instead of trending, we start trading sideways, we start going into a squeeze, and then boom, it fires off, and it's telling you that it's a long, and that you stay in the trade until it loses momentum. Okay, so that was good. You know, as a day trade, it's good for about 2 points. Right? Now, you can also do this, you know, whether you can do it as a day trade, but what I like about it is that you can also look at, you know, other time frames. So here's a 60-minute chart. And on the 60-minute chart, we're rallying, everything's going crazy, and then we go into a quiet period. Okay? The Bollinger Bands go inside of the Keltner channels. We start to get in the red dots, and then we fire off. And what I generally like to do is once we fire off, is I'll wait for a rally, in this case, since it's a short, back up to the 8-period moving average. All right? I'll use my limit order to get in there. And then manage the trade out this way. And I'll do the same thing. If we get, you know, in this case it's a 60-minute chart. If I get like plus 3 points, I'm going to take off a third. Plus 6 points, take off 2/3. And then when my stop's at break even, when we lose momentum, when we run out of momentum here, you can see we got 2 higher lows now, then get out of the rest of the trade. The question is, can you automate this in TradeStation? You can. What you want to do is, if you're trying to automate this in TradeStation, is like I was talking about at the beginning, is you don't want to have it take every signal. You want to have it match up. So like you want to have the anchor chart. So if the 60-minute chart, the TTMs are red, then you want to take just the short squeezes. Okay? So I always like to use an anchor chart like that in any of the trades. I'll talk about another example here. So here's gold. And now this is a monthly chart, okay? And this is obviously more for position trading and things like that. But you can see right here, I mean, wow, the monthly squeeze was valid. There was a monthly squeeze for 2 years here. Gold was in a quiet period for 2 years. It fired off long. This essentially ended the 20 or 25-year bear market in gold. And then we rallied up to like 400. And then we went into a quiet period again of 18 months. We got another squeeze, boom, long squeeze, bam. So what I like about this is instead of buying gold here and being flat for 2 years, you actually wait until a squeeze fires off and you actually participate in the run up. Okay? And then we went into another quiet period, got a squeeze, and the squeeze is still valid. Now the ironic thing here is all the gold bugs who bought, you know, gold at $800 an ounce 30 years ago, you know, when it got up to like, I think a lot of them I talked to when it got up to like, they're like, dear sweet baby Jesus, please go up to 600 so I can, you know, get rid of my position. So a lot of the gold bugs who are like, you know, very passionate about gold are not in it right now because they kept thinking it's going to come back. So it's kind of ironic. I mean, that's what happens when you get too tied up into the fundamentals or, you know, tied up in things like that. Just look at the signal.